Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs, and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button, and don't forget to turn on the bell for updates on all our latest content. Imagine this. You're sitting at your desk in the year 2025, looking at your financial goals for the next decade. You've got a solid $10,000 to invest, and you know you want to make your money work hard for you. You've heard about two investment opportunities that have caught your eye, QQQ and VTI, and both seem to promise great returns. But there's a catch. One's an aggressive bet on high-growth tech stocks, while the other offers broad, diversified exposure to the entire U.S. market. You're torn. Which one do you choose? Do you go all in on tech, betting that giants like Apple, Nvidia, and Amazon will continue to fuel the next wave of growth? Or do you opt for the stability and wide-reaching coverage of the U.S. market, investing in everything from healthcare and industrials to consumer staples? You're standing at a crossroads. It's not just about choosing an ETF. It's about choosing a strategy that will define your financial future. The temptation of rapid gains from tech stocks is alluring, but so is the peace of mind that comes with broad market exposure. You can almost feel the weight of the decision. But what if you didn't have to choose? What if there was a way to take advantage of both worlds, capturing the explosive growth of tech stocks while still protecting yourself from the inevitable dips and downturns that come with concentrated risk? What if you could blend both QQQ and VTI into one powerful strategy, giving you the best of both growth and stability? In this moment, you're about to discover a strategy that could change the way you think about investing. A strategy that takes the best features of both QQQ and VTI and combines them into one cohesive plan. A strategy that, when executed thoughtfully, has the potential to balance the thrill of high returns with the safety net of diversification. This could be your path forward, the key to unlocking your financial success in 2025 and beyond. And now the question isn't which ETF to choose. It's how you can harness the power of both to reach your goals faster, smarter, and more securely. When deciding where to invest your money in 2025, one of the most pressing questions for investors is whether to go with QQQ or VTI. Both of these exchange-traded funds, ETFs, are popular among individual and institutional investors. They offer different exposures, risk profiles, and growth potentials. Understanding the strengths and weaknesses of each is essential to making an informed decision, especially when a significant amount like $10,000 is on the line. In this article, we'll explore QQQ and VTI in depth, comparing their holdings, historical performance, sector exposure, risk, fees, and ideal investor profiles to help you decide which ETF fits your investment strategy best in 2025. Understanding the basics, what are QQQ and VTI? QQQ, or the Invesco QQQ Trust, is an ETF that tracks the NASDAQ 100 index. This index includes 100 of the largest non-financial companies listed on the NASDAQ stock market. It is known for its heavy tilt toward technology and innovation-driven sectors. Think of giants like Apple, Microsoft, Amazon, Nvidia, and Meta. As of 2025, QQQ is often viewed as a growth-oriented ETF that thrives in bullish market conditions, especially when tech is booming. VTI, or the Vanguard Total Stock Market ETF, on the other hand, provides broad exposure to the entire U.S. stock market. This includes large cap, mid cap, small cap, and even micro cap stocks. Managed by Vanguard, VTI tracks the CRSP US Total Market Index and is known for being highly diversified and a favorite among long-term buy and hold investors. It holds over 4,000 stocks, giving you a slice of nearly every public U.S. company, from Apple to small regional banks. Historical performance. Which one has delivered better returns? Performance is often the first metric investors look at. Over the past decade, QQQ has generally outperformed VTI. This is largely due to the dominance of technology and growth stocks in the 2000s and early 2020. For instance, between 2010 and 2023, QQQ delivered an annualized return of around 17%, while VTI trailed slightly with an average of around 12 to 13%. However, this doesn't tell the full story. QQQ's outperformance comes with higher volatility and risk. Its concentrated exposure to tech means it benefits tremendously when tech thrives but can also suffer disproportionately during market downturns, such as the tech sell-offs seen in 2022. VTI, with its broad market exposure, offers more stability and tends to recover steadily across sectors, even if tech faces temporary setbacks. Sector exposure, growth versus diversification. One of the most defining differences between QQQ and VTI is sector concentration. QQQ has over 50% of its holdings in technology-related sectors, including software, semiconductors, and internet services. This gives it high growth potential, especially in an era where AI, cloud computing, and digital transformation are accelerating. However, it also means you are more exposed to market sentiment swings related to the tech industry. VTI spreads its investments across all sectors, including financials, healthcare, industrials, consumer goods, energy, and utilities. While this means it won't surge as dramatically as QQQ during a tech rally, it also won't fall as hard during a tech crash. This diversification makes VTI a more balanced option for those seeking consistent long-term growth without putting all their eggs in one basket. Risk and volatility. How much are you willing to tolerate? Risk tolerance is a major factor in choosing between QQQ and VTI. QQQ is more volatile, with larger price swings and sharper corrections. This makes it suitable for investors with a higher risk appetite or a longer time horizon who can ride out market fluctuations. It's also ideal for those who want to bet on continued dominance of tech and innovation. VTI, in contrast, is more conservative. Thanks to its broader diversification, it has a lower beta, a measure of volatility, and offers more resilience during market downturns. If you're someone closer to retirement or more conservative with your investments, VTI could provide peace of mind with steadier performance. Fees and expenses, Vanguard's edge. Both QQQ and VTI have relatively low expense ratios, but VTI takes the lead in this category. As of 2025, QQQ has an expense ratio of 0.20%, while VTI's is only 0.03%. Though the difference may seem small, over a long period and with large investments, it adds up. For a $10,000 investment, you'd pay $20 annually in fees with QQQ and just $3 with VTI. Vanguard's commitment to low-cost investing makes VTI especially attractive for long-term investors looking to minimize costs. Tax efficiency and dividends. Both ETFs are relatively tax efficient and are structured to minimize capital gains distributions. However, VTI offers a slight advantage in dividend yield. While QQQ focuses on growth stocks that typically reinvest profits instead of paying dividends, VTI includes a broader range of companies, including those with higher dividend payouts like financials and utilities. As a result, VTI tends to have a dividend yield around 1.5 to 2.0%, compared to QQQ's sub 1% yield. If generating passive income is part of your investment strategy, VTI might be the better pick. But if you're more focused on capital appreciation and willing to forgo dividends for higher growth, QQQ could align more with your goals. Investment goals, long-term growth or balanced exposure? Choosing between QQQ and VTI comes down to your investment goals. If you're aiming for aggressive long-term growth and believe in the future of technology, QQQ might be the right choice. It's perfect for investors who can stomach volatility and want to capitalize on innovation-driven sectors. VTI, on the other hand, is suited for those seeking a more balanced approach. Whether you're a beginner investor, planning for retirement, or just want to build wealth steadily over time, VTI offers the diversification and stability needed for consistent long-term returns. How do economic trends in 2025 affect your decision? In 2025, macroeconomic conditions also play a key role in determining which ETF to choose. The Federal Reserve's monetary policy, inflation trends, AI adoption, global supply chain shifts, and consumer demand will all affect market behavior. If tech continues to lead economic transformation, especially with AI, machine learning, and digital infrastructure, then QQQ may once again outperform. However, if we see a broad-based economic recovery or rotation into undervalued sectors like energy, healthcare, or industrials, VTI's diversification could outperform QQQ's narrow tech focus. Also, potential regulatory crackdowns on big tech or slowing growth in the tech sector could make QQQ more vulnerable than VTI. Combining both, a blended strategy. Combining both QQQ and VTI in a single portfolio offers a thoughtful way to balance growth potential and risk management, leveraging the strengths of both ETFs. Rather than choosing between the two, this blended approach allows investors to diversify their holdings, combining the explosive growth of QQQ's tech-heavy portfolio with the broad market exposure and stability offered by VTI. By doing so, investors can align their portfolios with their risk tolerance, financial goals, and market outlook, while avoiding overconcentration in one sector or asset class. The key benefit of this strategy lies in the diversification it provides. QQQ is concentrated in a few high-growth sectors, particularly technology, which can deliver strong returns, but also carries significant volatility. In contrast, VTI offers exposure to a broad range of sectors, including not only tech, but also healthcare, consumer staples, financials, and more. These sectors tend to be less volatile and provide stability during market downturns. This means that while QQQ might soar during a tech rally, VTI's broader exposure can help cushion the impact of a tech downturn, giving investors a more balanced risk-return profile. An example of a blended strategy could be allocating 70% of your investment to QQQ and 30% to VTI. This allocation gives you a larger exposure to the growth potential of tech, while still retaining the broad market exposure of VTI. This is ideal for investors with a higher risk tolerance who are willing to bet on the continued strength of the tech sector, but still want some stability from the diversification VTI provides. Conversely, a more conservative allocation, say 30% in QQQ and 70% in VTI, would tilt the portfolio towards stability and long-term growth, with a focus on minimizing risk and ensuring that the portfolio is not overly exposed to any single sector or asset class. Another option is a 50-50 blend of QQQ and VTI, which is an ideal middle ground for investors who want to participate in the growth of the tech sector without abandoning diversification. This strategy would provide a mix of high-potential returns from tech stocks, along with the stability of VTI's exposure to the broader market. This balanced approach ensures that your portfolio can participate in the growth of the tech sector, while also benefiting from the steadier performance of other sectors like healthcare, consumer goods, and financials. The beauty of combining QQQ and VTI is that it allows investors to customize their portfolios based on their financial goals, investment horizon, and risk tolerance. For example, younger investors or those with longer time horizons may lean more heavily toward QQQ to maximize potential returns, while those closer to retirement or with a lower risk appetite might prefer a larger allocation to VTI for its stability. Additionally, the strategy gives investors the flexibility to rebalance their portfolio periodically, adjusting the ratio of QQQ and VTI depending on their evolving financial needs or changes in market conditions. In summary, a blended strategy using both QQQ and VTI offers the best of both worlds: the growth potential of QQQ's tech-heavy holdings and the stability and diversification provided by VTI. Whether you're seeking aggressive growth, a balanced approach, or a more conservative strategy, combining the two can help you tailor your investment portfolio to your specific goals and risk profile. Where should you invest $10,000? If you're looking for explosive growth and are comfortable with volatility, QQQ is a compelling choice. It's ideal for those with a strong belief in tech innovation and a long investment horizon. Just be prepared for potential swings, especially during market corrections or tech-specific downturns. If you prefer a more conservative, diversified, and stable investment that grows steadily over time, VTI is the better option. It's particularly attractive for investors who value low fees, consistent returns, and dividend income. For those newer to investing or seeking a set-it-and-forget-it strategy, VTI offers peace of mind and simplicity. Ultimately, the decision should reflect your risk tolerance, financial goals, and view of the market in 2025. Both QQQ and VTI are excellent ETFs, and either or both can play a valuable role in a well-rounded investment portfolio. With a clear understanding of what each ETF offers, you can make a confident choice that aligns with your personal financial journey. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.